RBI policy rates. The Reserve Bank of India, RBI, is responsible for formulating and implementing monetary policy in India. The central bank uses various tools to regulate the money supply in the economy and control inflation. One of the primary tools used by the RBI is the policy rate, which is the rate at which it lends money to commercial banks. There are several policy rates that the RBI uses to manage the economy, including Repo rate. The repo rate is the rate at which the RBI lends money to commercial banks. When the RBI increases the repo rate, it becomes more expensive for banks to borrow money, which reduces the money supply in the economy. This helps to control inflation by reducing demand for goods and services. Reverse repo rate. The reverse repo rate is the rate at which the RBI borrows money from commercial banks. When the RBI increases the reverse repo rate, it becomes more attractive for banks to lend money to the central bank, rather than to customers or other banks. This reduces the money supply in the economy and helps to control inflation. Marginal Standing Facility, MSF, rate. The MSF rate is the rate at which banks can borrow money from the RBI overnight, using government securities as collateral. The MSF rate is usually higher than the repo rate, and is used to discourage banks from borrowing money from the RBI in case of emergency. Bank rate. The bank rate is the rate at which the RBI lends money to commercial banks for longer periods, typically up to 90 days. The bank rate is used to influence the lending rates of commercial banks, and hence the interest rates that customers pay on loans. The RBI uses these policy rates to manage the economy and achieve its objectives of controlling inflation, promoting economic growth, and maintaining financial stability. By adjusting these rates, the RBI can influence the money supply, inflation, and interest rates in the economy, which in turn affect investment, consumption, and overall economic activity. Thank you.